Every few months, you hear the exact same headline. Prices are up again. Milk costs more, rent costs more. Your paycheck buys less than it did last year. We all feel it, and we all talk about it. Where does that lost value go? It doesn't just vanish into thin air. Someone, somewhere, benefits every single time your money is worth less. To really anchor this, let's look at a simple math reality. If your grocery bill was $100 last year, and it's $107 this year for the exact same items, you've just experienced 7% inflation. The items didn't get 7% better, right? Your money just got 7% weaker. Most explanations stop right at that grocery store receipt. And honestly, that's just not enough. The truly crucial point here is that inflation isn't really about prices going up. It's about the money itself losing value. Prices are literally just the symptom. The real story is what's happening to the currency itself. You see, money only has value because of trust. Trust that the amount in circulation is limited, and trust that it'll still buy roughly the same things tomorrow as it does today. Inflation happens when that trust gets stretched, usually because there's just more money chasing the exact same amount of goods. You've got demand pull on one side, where everyone's wallet gets fatter at the exact same time. And then there's cost push, where the actual cost of production spikes. Let's break these down. Demand pull inflation happens when people simply have more money to spend than there are goods available to buy. Think of an economy like a giant auction. If everyone suddenly has a lot more cash to spend, but there's absolutely nothing new on the shelf, the prices simply get bid up. Cost push inflation works entirely differently. Instead of demand rising, the cost of making things rises. We're talking about massive external shocks, a spike in oil prices, a broken supply chain, or a sudden shortage of key materials. When this happens, businesses are essentially forced to pass those higher costs directly onto you. Raising interest rates is the classic textbook tool central banks use to cool down demand pull inflation. But doing so during a supply shortage, it does absolutely nothing to create more goods. It just makes borrowing money more expensive on top of already expensive goods. We can see the absolute best proof of this by looking back at the great stagflation of the 1970s. Through the late 60s and 70s, inflation just kept climbing alongside surging unemployment. For decades, many believed this was purely due to external supply shocks, like the sudden oil crisis. But researchers dug deeper and uncovered a hidden dynamic during this era, a financial friction called Regulation Q. This was a historic banking law that placed a hard, inflexible ceiling on the interest rates banks were legally allowed to pay their depositors. Let's walk through this tragic little sequence. When the Federal Reserve raised interest rates to fight inflation, those rates eventually shot right past that Regulation Q ceiling. Regular depositors, chasing better returns, pulled their money out of bank deposits. Facing massive capital outflows, banks immediately stopped lending. And suddenly, everyday businesses lost their access to vital working capital. As the historical research highlights, this wasn't just a banking hiccup. By depriving firms of credit, these Regulation Q crunches functioned as repeated, internally generated negative supply shocks, piling right on top of the existing oil shocks. To really get why this happened, you have to look at how businesses actually run. Firms rely heavily on bank loans to pay for materials and labor up front, well before they ever sell a finished product. This massive credit squeeze meant that producing everyday items became significantly more expensive, almost overnight. As a result, they had absolutely no choice but to raise retail prices and cut their production output just to survive the credit crunch. Ironically, by trying to tighten the money supply, policymakers effectively created even more cost-push inflation. This brilliantly illustrates a massive, massive paradox. You have the central bank's pure intent to cool consumer demand by raising rates, completely clashing with the market reality under Regulation Q, which crushed business supply lines. The fix backfired spectacularly. So, what's the big takeaway from all this 1970s data? It's that central banks cannot just assume supply will be perfectly fine and act independently while they forcefully pull on the demand levers. Ultimately, as the source literature concludes, whether raising interest rates actually helps your grocery bill or inadvertently hurts it depends entirely on the health of the financial plumbing. If businesses are highly vulnerable to credit crunches, tightening policy can actually constrain supply and push prices even higher. We've now seen the setup and the causes of inflation. and we've explored how complex the mechanics of fixing it can actually be. But this leaves us with an incredibly important question that most people just treat it like a mysterious force of nature, but it's really not. Inflation is actually the predictable result of decisions made by very specific actors in the financial system. To really grasp what's happening to the cash in your wallet, we first got to trace the actions of the institutions that control the supply of money itself. Here's our quick roadmap for today. We're looking at the money creators, the government's role, and then the inflation scoreboard. And trust me, understanding these high-level macro mechanics will lead directly to understanding the impact on your own personal finances. Right, so how does this actually work? Well, when a central bank wants to stimulate the economy, it lowers interest rates or buys massive amounts of government debt. Mechanically, this makes it cheaper and easier for money to just be created and circulated through the banking system. The result? It leads to that classic scenario you've probably heard of. More money chasing the exact same number of goods. When extra money enters the economy without a matching increase in actual stuff, goods and services, boom, that creates inflation. And this brilliantly illustrates the dynamic. When the Fed buys securities, it funds that purchase by increasing the deposits held by banks at the Fed, which are bank reserves. Our source material notes that these reserves act essentially as licenses. So by handing out more of these licenses, the central bank is literally allowing commercial banks to create more money out of thin air. To really put the sheer institutional scale of this into perspective, look at past economic recoveries. The Fed has bought over $2 trillion of government-backed securities. To fund a purchase that massive, they had to triple the amount of reserve deposits held by banks. It is crucial to see the parallel here. When a government spends more money than it collects in taxes, it runs a deficit and has to borrow the difference, right? Well, if that borrowing is financed in ways that expand the overall money supply, it has the exact same inflationary effect as a central bank printing new currency directly. Debt creation and reserve creation basically work hand in hand to flood the entire system with liquidity. Now, let's be completely objective for a second. None of this means inflation is some sort of evil conspiracy. It's actually a system of deliberate economic trade-offs. The whole goal of cheap money is often to boost employment and encourage investment when the economy is struggling. But it comes at a very real cost, and that cost is the slow, steady erosion of what your savings are actually worth. The scoreboard creates a super clear dichotomy because, look, inflation isn't a tide that lifts or sinks all boats equally. It creates distinct, mathematically predictable winners and losers. On one side, we've got debtors and asset owners. On the flip side, savers and fixed income earners. Let's start with the winners. Debtors win. Imagine you owe $300,000 on a fixed-rate mortgage, and inflation just spikes. Because the value of the currency is dropping, you're paying that debt back with dollars that are worth way less than when you originally borrowed them. In a very real sense, fixed-rate borrowers are the quiet beneficiaries of all that extra money getting pumped into the system. Asset owners also tend to win. Things like real estate, stocks, and other tangible assets usually rise in price right alongside inflation. Why? Because they represent claims on real, physical things, not just holding cash. And honestly, this is a huge reason why wealth inequality tends to widen during periods of high inflation. The people who already own assets see their net worth go up, while folks living paycheck to paycheck are left absorbing the full cost of inflation. At the grocery store, checkout line became sharply negative. Households rationally pulled their savings out because leaving money in the bank literally meant losing wealth. Now, what's really interesting about this math is the brutal reality of being during inflation. If your money just sits in a bank earning, say, 1% interest, but inflation is running at 4%, yeah, your balance is technically growing on paper. But in reality, your purchasing power is quietly going up in smoke while you're congratulating yourself for saving. That 3% difference is everything. You are effectively paying a 3% hidden tax on your savings. This perfectly personalizes all that high-level macroeconomic theory we just talked about. When central banks issue those licenses to create money, this 3% loss is exactly how you foot the bill for the newly created currency. And finally, fixed income earners lose the absolute most. People on fixed pensions or who rely entirely on savings-dependent incomes have no way to adjust their income upward as prices rise. Unlike a business that can just hike its prices or an employee who might negotiate a cost of living raise. Fixed income earners are, without a doubt, the most exposed and vulnerable group on the entire inflation scoreboard. So let's tie this whole shebang together. Inflation is absolutely not a mysterious force that just attacks an economy out of nowhere. It is the highly predictable result of institutional decisions regarding the money supply, government spending deficits, and interest rates. And once you understand those mechanics, inflation stops being this incredibly confusing thing. Now that you have this framework, you're empowered to ask way more useful questions the next time you see a headline about inflation. First thing to ask, is this inflation coming from extra demand, fueled by cheap money? Or is it coming from the cost side, like a sudden supply chain shock? Second question, who is actually benefiting from the extra money in the system? Think back to those bank reserves. Trace the actions of the central banks and the governments to see exactly who is getting the licenses to create and access that brand new money first. And finally, trace this back to your own life. What does this all mean for anyone holding debt versus anyone holding cash savings right now? If this explainer helped to make the bigger economic picture a little clearer for you, definitely make sure to subscribe, because we break down the economy one mechanism at a time here.